October 29th, 1929. Black Tuesday. The day the impossible happened. The New York Stock Exchange, the beating heart of American prosperity, collapsed. Fortunes built over decades vanished in hours. Men who'd been millionaires at breakfast were bankrupt by lunch. But here's what nobody tells you about that day. The crash didn't come from nowhere. For months before, the smartest people in America stood up and said the market was overvalued, unsustainable, heading for disaster. They were ignored, ridiculed even, because the market had been rising for so long that people stopped believing it could fall. They'd convinced themselves they were different, that the old rules of economics didn't apply anymore, that this time was special. They were wrong. And here's the terrifying part. Right now, in 2025, we're seeing the exact same pattern. Not similar, identical. The American stock market is exhibiting every single warning sign that appeared before the crashes that destroyed three of history's greatest empires: Spain, the Netherlands, Britain. Each one believed they were exceptional. Each one ignored the pattern. Each one collapsed in the same way, following the same sequence, making the same fatal mistakes. The question isn't whether the pattern exists. It's whether we're near the beginning, the middle, or the end. There's a question that should keep every economist awake at night. Why do the greatest financial powers always collapse when they appear strongest? Not during obvious decline, but at the peak, when the markets are soaring, when confidence is absolute, when everyone believes the system has finally been perfected. This isn't coincidence. It's the pattern. And it's happened 4 times in recorded history, following an identical sequence each time. Economist Hyman Minsky spent his career studying this paradox, and what he discovered was profound. Financial systems, he proved, naturally evolve from stability to catastrophic instability. The process has 3 stages. First comes hedge finance, the cautious period after a crisis when investors only borrow what they can repay using actual cash flow. Then comes speculative finance, where rising confidence leads people to borrow more, covering only interest payments while rolling over the principal, betting on continued growth. And finally, the Ponzi phase, where the entire system survives only by acquiring new debt to service old debt, sustained purely by the belief that asset prices will keep rising forever. The critical insight is this: the transition from stage 2 to stage 3 is invisible to the people inside the system. The market looks strongest at precisely the moment it becomes most fragile. Prices are at record highs. Optimism is universal. Anyone warning of danger is dismissed as a pessimist who doesn't understand the new paradigm. This is the Minsky moment, the instant when collective belief shatters and everyone realizes simultaneously that the foundation was imaginary. When that happens, the collapse is not gradual. It's exponential. History has tested this theory 4 times with real empires, real currencies, and real human suffering. Spain in the 17th century, the Netherlands in the 18th, Britain in the 20th, and now the United States in the 21st. Each one followed the exact same progression. Each one believed they were exceptional. Each one was destroyed by the same internal contradictions. The math of empire is absolute. You cannot print prosperity. You cannot borrow forever. And you cannot debase your currency without destroying everything built on it. The Spanish Empire in 1545 discovered the Cerro Rico mountain in what is now Bolivia. It wasn't just a silver mine. It was the largest silver deposit ever found in human history. For the next century, Spanish ships carried unimaginable wealth across the Atlantic. They minted it into coins that became the first global currency. Spain controlled territories on every continent. They were the superpower of their age. And then the silver destroyed them. Because there's a paradox with money. More of it doesn't make you richer if everyone has more. When Spain flooded Europe with silver, prices didn't stay stable. They exploded. What cost 1 silver coin in 1500 cost 10 coins by 1600. But Spain wasn't just causing inflation in Europe. They were destroying their own economy from within. The influx of silver caused what economists now call the Dutch disease or resource curse. The massive incoming wealth drove up Spain's price level by 200% compared to other European nations. This made everything Spain produced uncompetitively expensive. Spain's textile industry collapsed. Their manufacturing base evaporated. They became net importers of goods they used to produce themselves, paying for everything with silver that was rapidly losing value. The economic analysis is devastating. Despite an initial boom where Spain's income per person outperformed the rest of Europe for a century, by 1750 their economy was 40% smaller than it would have been if they'd never discovered the silver at all. The wealth didn't save them. It gave them the capacity to make catastrophic mistakes for longer. But the real destruction came from the debt. King Philip II inherited 36 million ducats in debt in 1556. He kept borrowing to fund wars, palaces, and imperial ambitions. By 1607, the debt had reached 85 million. Debt servicing alone consumed between 40 and 50% of all government revenue. The crown couldn't function. They defaulted in 1607, then again in 1627, and again in 1647. Each default destroyed international confidence and triggered credit crises across European banking centers. Meanwhile, Spain's tax system was fundamentally broken. Revenue came primarily from regressive sales taxes that crushed the lower classes, while the nobility and clergy enjoyed broad exemptions. The government couldn't raise enough money because they refused to tax the people who had money. The institutional failure was complete, and here's the lesson. The silver wasn't the problem. The problem was that wealth masked the underlying rot. It allowed incompetent leadership to persist in destructive policies far longer than a poor nation could have afforded. The empire didn't collapse because they ran out of silver. It collapsed because the silver allowed them to avoid necessary reforms until it was too late to save themselves. The Dutch Republic in the 1630s was the richest, most sophisticated financial center in the world. Amsterdam was the hub of global trade. The Dutch guilder was the reserve currency of Europe. They'd pioneered modern banking, insurance, and futures markets. They were the model of commercial success. And then, in the winter of 1636, they went collectively insane over flowers. Tulip mania is often dismissed as a curious historical footnote, but it reveals something profound about financial bubbles. The speculation started with genuine scarcity. Certain tulip varieties with striking color patterns were genuinely rare, and wealthy collectors competed for them. Then forward contracts emerged, allowing people to buy and sell tulips that hadn't even bloomed yet. This created a market detached from physical reality, trading purely on anticipated future value. The prices became absurd. In February 1637, a single bulb of the Viceroy tulip sold for between 3,000 and 4,200 guilders. That was more than 10 times the annual income of a skilled craftsman. People were trading houses for flowers. The entire economy became consumed by tulip speculation. And then, in a single week, it ended. Buyers simply stopped appearing. The forward contracts became worthless overnight. Fortunes vanished. The tulip bubble popped. Modern analysis suggests the direct economic damage was limited because the Dutch economy was large and diversified enough to absorb it. But the psychological impact was permanent. It demonstrated that even the most rational, financially sophisticated society could succumb to collective delusion. And research into bubble formation reveals why. In homogeneous markets, where traders share similar backgrounds and social circles, they place undue confidence in each other's decisions. This creates conformity bias. Everyone assumes that if everyone else is buying, the price must be justified. The tight social networks of Dutch merchants accelerated the mania precisely because they trusted each other too much. But tulip mania wasn't the real destruction of Dutch financial dominance. That came from something far more insidious. The Dutch guilder's status as the reserve currency of Europe gave the Netherlands what economists call exorbitant privilege. They could borrow at the lowest interest rates on the continent. Capital flowed into Amsterdam from across the world. This appeared to be pure advantage. It was actually a trap. The Bank of Amsterdam, which managed the currency, became complacent. They engaged in accommodative policies, extending credit beyond prudent limits, confident that their reserve currency status protected them from consequences. By 1784, detailed analysis of the bank's balance sheet reveals they had become policy insolvent. If they'd followed their stated objectives, their net worth would have been negative. The institution was technically bankrupt, masked by continuing inflows of foreign capital. Between 1781 and 1792, when the market finally recognized this weakness, the guilder rapidly lost its reserve status. The fall was not gradual. It was sudden and irreversible. The lesson is chilling. Reserve currency status creates the conditions for institutional failure. The ability to borrow cheaply encourages monetary authorities to believe they can extend credit indefinitely, support failing institutions, and avoid hard choices. The privilege becomes the mechanism of destruction. The Netherlands didn't lose their financial dominance to a superior competitor. They destroyed it themselves through the arrogance that privilege enabled. The South Sea bubble of 1720 stands apart from tulip mania in one critical way. The tulips were at least real. The South Sea Company was a politically engineered fraud from the beginning. Robert Harley founded it in 1711 as a solution to Britain's overwhelming national debt from wars. The scheme was elegant in its deception. The government would convert high-interest debt into South Sea Company stock, and the company would gain exclusive trading rights in South America, including the Asiento contract for slave trading. The problem was that the trading rights were nearly worthless. Spain controlled South America, and they had no intention of allowing British commercial dominance. But the company didn't need real profits. They needed belief. And they had something more powerful than business fundamentals. They had royal endorsement. In 1718, King George himself became governor of the company. When the monarch backs a venture, skepticism becomes treason. The stock price began rising based purely on speculation and political manipulation. Insiders spread rumors of vast wealth from South American trade that didn't exist. They issued new shares to create the illusion of demand. The price climbed from £100 to £300, then to £600. By August 1720, it had reached £1,000 per share. People mortgaged their homes to buy in. The mania consumed London. And then, in September, it collapsed. No dramatic news, no external shock. The bubble simply ran out of new buyers. By December, the stock had fallen to £124. 80% of the value vanished in 4 months. The devastation was total. Families were ruined. The public rage was immense. Suicides spiked across London as people realized they'd been destroyed by a scheme endorsed by their own government. The most haunting detail is Sir Isaac Newton, the man who discovered the laws of gravity, who could calculate planetary orbits with perfect precision, lost the equivalent of £40 million in the crash. When asked about it later, he reportedly said he could calculate the motions of heavenly bodies, but not the madness of people. This illustrates the core truth. Intelligence offers no protection against systemic delusion. When the entire financial structure turns Ponzi, even genius cannot save you. Britain survived the South Sea bubble, but the pattern of debt and speculation only intensified. By 1815, after the Napoleonic Wars, Britain's national debt exceeded 200% of GDP. They borrowed heavily again for both world wars. The empire was built on credit, sustained by the pound sterling's status as the global reserve currency. As long as the world trusted the pound, Britain could borrow at favorable rates and maintain their imperial structure. But empires are expensive, and debt compounds. The final marker of decline came in the 1970s with the sterling crisis. Inflation hit 25%. The currency was collapsing. And for the first time in modern history, Britain was forced to seek a bailout from the International Monetary Fund. This was the definitive moment. The empire that had once controlled a quarter of the earth was now a managed client, dependent on external support. The loss of financial sovereignty, not military defeat, marked the true end of British dominance. They hadn't been conquered. They'd bankrupted themselves. When you place Spain, the Netherlands, and Britain side by side, the pattern becomes undeniable. The sequence is identical. First, dominance. The empire controls the reserve currency, enjoys the lowest borrowing costs, and appears invincible. Second, overextension. Military commitments, imperial ambitions, and domestic promises exceed sustainable revenue. Third, deficit spending. The gap between income and expenditure becomes structural and permanent. Fourth, currency debasement. Whether through inflating silver, accommodative banking policy, or abandoning gold backing, the currency loses its anchor to real value. Fifth, inflation. Prices rise as the currency loses purchasing power, eroding savings and destabilizing the economy. Sixth, loss of confidence. Domestic populations and foreign nations begin to doubt the currency's stability, accelerating the decline. Seventh, collapse. The financial system fails, the empire loses its ability to fund itself, and dominance ends. The progression is not a theory. It's documented historical fact, repeated across 3 centuries with 3 different empires. And the mechanism driving it is precisely what Minsky described. Stability breeds complacency. Complacency encourages excessive leverage. Leverage creates fragility masked by rising prices. And when the belief in perpetual growth breaks, the collapse is exponential, not gradual. The most dangerous phase is stage 6, the loss of confidence, because it can trigger suddenly from seemingly minor events. For Spain, it was repeated defaults that destroyed creditor trust. For the Netherlands, it was the revelation of the Bank of Amsterdam's insolvency. For Britain, it was the humiliation of needing an IMF bailout. Each moment represented the market collectively realizing that the emperor had no clothes. Once that realization spreads, it cannot be reversed through policy alone. Trust, once lost, cannot be printed. The United States in 2025 is exhibiting every single indicator that preceded the collapse of previous empires, but amplified by the scale and complexity of modern finance. Start with the currency. The dollar has been the world's reserve currency since 1944, established at Bretton Woods when it was backed by gold at $35 per ounce. That backing ended in 1971 when President Nixon closed the gold window, making the dollar a pure fiat currency, sustained only by trust and the government's promise. Just like Rome debasing the denarius, just like Britain abandoning gold, the spending follows the same trajectory. In 1980, U.S. national debt was $900 billion. Today, it exceeds $36 trillion. That's a 40-fold increase in 45 years. The debt is growing by roughly $2 trillion per year, even during periods of economic growth. Deficit spending is no longer a crisis measure. It's the permanent structure of the system. And just like Spain, just like Britain, debt servicing is consuming an ever larger portion of revenue. In 2024, over $1 trillion of federal tax revenue went purely to interest payments. Not defense, not infrastructure, not healthcare, just interest on past borrowing. The money printing accelerated dramatically after 2008. Quantitative easing, the Federal Reserve called it, creating trillions of dollars from nothing to stabilize the financial system. During the pandemic, they printed over $4 trillion in 2 years. More currency created than in the previous century combined. And just like every empire before, they insisted it wouldn't cause inflation. That modern economics had solved the old problems. That this time was different. It wasn't. Inflation hit 9% in 2022. Real prices for housing, food, and healthcare have risen far beyond official measures. But the most critical indicator is the loss of reserve currency status. In 2000, over 70% of global reserves were held in dollars. Today, it's 58% and falling steadily. The BRICS nations are actively building alternative payment systems. China and Russia are trading in their own currencies. Central banks worldwide are buying gold aggressively and diversifying away from dollar dependence. The world is preparing for the dollar to lose its dominance, exactly as they prepared for the pound to fall before Britain's collapse. The United States also faces the same military overextension that destroyed Rome and Britain, nearly 800 military bases in over 70 countries, a defense budget exceeding $800 billion annually, wars in Iraq and Afghanistan that cost over $8 trillion. The empire is expensive, and it's being funded with debt and printed money. The pattern is not similar to past empires. It is identical. Hyman Minsky identified the most dangerous moment in any financial cycle, the point where the market appears strongest, where confidence is universal, where anyone suggesting caution is dismissed as ignorant. He called it the Minsky moment, the instant when everyone realizes simultaneously that the foundation is imaginary. The 1929 crash, the 2008 financial crisis, the South Sea bubble, tulip mania. Each one followed the same pattern: stability encouraging speculation, speculation creating leverage, leverage hidden by financial complexity, and finally, the sudden recognition that the system had entered the Ponzi phase. The American stock market in 2025 exhibits classic late-stage bubble characteristics. Valuations have detached from underlying earnings. Speculation is rampant in assets with no intrinsic value. Leverage is extreme, with margin debt at historic highs. And most telling, there's universal belief that the market cannot fall, that the Federal Reserve will always intervene, that this time is genuinely different. But history proves that exceptionalism is not immunity. Spain believed their silver made them special. The Dutch believed their commercial sophistication made them immune to irrationality. Britain believed the pound's dominance was permanent. All three were wrong. The pattern does not care about American military strength or technological advancement or economic complexity. The pattern is mathematical. You cannot spend more than you earn forever. You cannot print prosperity. And you cannot debase your currency without destroying everything built on it. The only questions remaining are timing and severity. How long until the world loses confidence in the dollar? How fast does the collapse happen when it begins? Will it be a controlled decline like Britain after 1945, a slow, painful adjustment to diminished status? Or will it be chaotic collapse, a sudden systemic breakdown like Rome in the 5th century? Or will there be a reset, a new currency system established to replace the dollar, painful but survivable? The historical pattern suggests we are in stage 6, the loss of confidence. Foreign nations are actively reducing dollar dependence. Domestic inflation is eroding purchasing power. The debt is unsustainable at current trajectories. These are not predictions. They are measurable indicators, identical to those that preceded every previous imperial collapse. The pattern has completed 4 times across 2,000 years. Different empires, different technologies, different assets, but the same sequence. The same hubris, the same denial, and the same ending. The American financial system stands at the zenith of illusion, the moment where the market appears strongest right before it breaks. The pattern is complete. The only variable is how fast it unfolds and how severe the consequences become, because the pattern never lies. And history has already shown us exactly how this ends.